Everyone wants to get rich investing, but in 2025, most people are doing the exact things that quietly destroy their wealth. Not because they don't try hard enough, but because they don't know what's actually holding them back. This week, headlines are saying big tech is borrowing over $200 billion to fund the AI boom. It sounds massive, but what does it really mean for investors like you and me? Is it a sign of opportunity or a warning about risk? Welcome to Invest Education Hub, where we turn smart investing into simple decisions. Stay with us until the end. This might completely change the way you see innovation, risk, and long-term investing.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
Okay, let's just start with a number that should make you sit up and pay attention. $78 billion. And get this, that's not a yearly budget or some 5-year plan. That's how much cash just 3 companies, we're talking Meta, Microsoft, and Google, have poured into AI in the last 3 months alone. To put that into perspective, that's bigger than the entire economy of some countries. We are literally witnessing one of the most aggressive, most expensive investment cycles in history, and it's all focused on one single technology. The scale is just, it's hard to wrap your head around, and it's all happening right now. So, okay, when you see a number that huge, the big question for any of us as investors is, what does it mean for my money? Is this a massive green light, a signal that we're about to hit a crazy productivity boom and we should all be jumping on these stocks? Or is it a red flag, a warning sign that we're just blowing up a massive bubble based on hype? This is the central question, the real puzzle we're going to solve today. And believe me, understanding what's really going on here is your single biggest advantage. To really get to the bottom of this, here's the game plan. First, we'll dig into the mind-boggling scale of this billion-dollar AI bed. Then, we're going to demystify the tool they're using to pay for it all, corporate debt. And you'll see why there's a huge difference between smart borrowing and desperate borrowing. Next, we'll look at Wall Street's kind of weird mixed signals, why they're cheering for some of these companies but punishing others. After that, we'll zoom out and see how this all fits into a timeless pattern I call the hype trap. And finally, we'll boil it all down into a simple, long-term strategy that you can actually use. So, Section 1. Let's start with what's actually going down. The biggest names in the game, Apple, Microsoft, Google, Meta, Amazon, are raising absolutely staggering amounts of money. We're talking hundreds of billions of dollars, and almost every penny is being funneled into one thing, going faster and bigger on artificial intelligence. This cash is for building the actual physical guts of the AI revolution. I'm talking massive data centers, buying up every advanced chip they can get their hands on, and beefing up their cloud infrastructure to handle the insane amount of computing power this all takes. This isn't just some small project. It's a complete reshaping of the entire tech industry. Now, you probably hear the word debt, and your brain immediately flashes a warning sign, right? Like, debt is bad. But in the world of big business, it's not that simple. To really understand it, this AI spending spree is a golden opportunity or a huge risk. We have to understand the mean tool they're using to pay for it. And that tool is corporate debt. So what exactly does that mean? Okay, in the simplest possible terms, a corporate bond is basically a fancy IOU. A huge company like Apple says, hey, lend me $1 billion. I promise I'll pay you back in, say, 10 years. And for your trouble, I'll give you a little interest payment every single year. Investors, from giant pension funds all the way down to regular people, buy these bonds. The company gets a huge pile of cash to build cool new things, and the investors get a nice, steady income stream. It's one of the most fundamental ways that big, successful companies fund their growth. So you might be asking, why borrow money? Why not just sell more stock? And that's a great question. This slide lays out the trade-off perfectly. See, when a company sells stock, it's selling a tiny piece of itself. It's giving up ownership, and that waters down the value for everyone who already owns shares. But with debt, the company gives up zero ownership, none. They keep full control. Now sure, they have to pay the loan back with interest, but here's the kicker. Those interest payments are usually tax deductible. That makes the real cost of that debt even cheaper. For a company that's already making tons of money, using debt is often a really, really smart financial move. And this brings us to the most important point of this whole section. Not all debt is the same. There's good debt, and then there's bad debt. Bad debt is when a company is in trouble and they have to borrow money just to keep the lights on or to pay their employees. It's a sign of desperation. But good debt, that's strategic. That's when a healthy, profitable company borrows money to build something that's going to make them even more money in the future, like a new AI data center. It's a sign of efficiency. It shows that the people in charge believe they can earn a much higher return on that money than the interest they have to pay on the loan. And this right here is the key to understanding big tech right now. When you see a company like Microsoft, which is sitting on a literal mountain of cash, go out and borrow billions more, it's not because they're in trouble. It's the exact opposite. It's a power move. They can often borrow money at super low interest rates, they get a tax break on it, and it lets them keep their own cash free for other things. They're using debt as a sharp, efficient tool to fund what they believe is the next huge wave of growth for the entire world. Okay, so these companies are making a smart, strategic bet on the future. You'd think Wall Street would be throwing a parade for them, right? Well, not exactly. The market's reaction has been, frankly, all over the place. And this part is like a live case study in how investors are trying to figure all this out. It shows us that the market isn't just blindly rewarding spending. It's looking really, really closely, and it is not giving everyone a free pass. This quote from Bloomberg just nails the whole mood right now. The market is fickle. This is what price to perfection means. What does that even mean, price to perfection? It means that expectations for these companies are already through the roof. Investors have already assumed huge success from AI is coming. So when these companies announce their plans, if there's even a tiny hint that things aren't going flawlessly or that profits aren't showing up fast enough, the stock can get absolutely hammered, even if the long-term plan is still solid. And this slide lays it out in black and white. It's fascinating. You have three tech giants all spending billions on the same thing, but look at the totally different reactions they're getting. Alphabet, Google's parent company, its stock went up. Why? Because they came with receipts. They could point to real results, a big jump in their cloud business, and a ton more people using their Gemini AI. They connected the dots between spending and profits. But then, look at Meta and Microsoft. Both of their stocks dropped. So why the difference? Let's dig in. Let's start with Meta because, wow, the stock got crushed, down over 10% in one day. And what caused it? Mark Zuckerberg basically just told investors to get ready for a notable increase in spending next year. That's it. And the market freaked out. It's not that investors hate AI, it's that they heard exploding costs without a clear story about exploding profits to go with it. They want to see the payoff, not just the bill. Now compare that to Alphabet. They could deliver the proof. They could actually show how their AI investments were already making them more money. They could say, look, our cloud business is growing like crazy because of AI. The number of people using our AI tool, Gemini, is way up. They answered the big question, where's our return on this massive investment? And that is what the market wanted to see. So this brings us to a really, really important question. Why on earth would the market punish a company like Meta for investing heavily in what everybody agrees is the future? It feels completely backward. But the answer has less to do with AI specifically and more to do with a timeless psychological pattern that we see in the markets over and over and over again. Understanding this pattern is the key to not getting caught in the same trap yourself. And that brings us to the hype trap. You see, what's happening with AI right now, it's not new at all. In fact, it's a story as old as investing itself. Every few years, some game-changing new technology comes along and just captures everyone's imagination. And almost every single time, it follows a very predictable and often very painful cycle. Just think about it. In the late 90s, it was the internet and the dot-com bubble. And yes, the internet absolutely changed the world, but most of those dot-com stocks went straight to zero. In the 2010s, it was the crypto frenzy. Then in the early 2020s, it was the EV boom. Every single time, you have a powerful story about the future that creates this investing mania. And now, in 2025, it's the AI revolution. The technology is different, but the human psychology driving it all, it's exactly the same. And that cycle pretty much always follows these 4 stages. First, there's greed. A new technology pops up and people see its incredible potential. Then comes the hype. The story goes viral, your uncle is talking about it at Thanksgiving, and stock prices just go vertical because investors are terrified of missing out. That's FOMO. Then, almost inevitably, comes the correction. Reality kicks in. People realize that the company's profits aren't growing anywhere near as fast as its stock price, and the whole thing comes crashing down. But here's the important part. After the crash, after the hype dies, that's when the real opportunity shows up. The solid companies, the ones with actual profits and real business models, they survive and go on to dominate for decades. So the whole point is this. Smart investors do not get swept away by the story. They don't chase the flashy headlines or the hype. They study the fundamentals. They look right past the exciting story about changing the world, and they look at the boring stuff, like the balance sheet. They focus on the business itself. Because a great story, unfortunately, does not always make a great investment. So how do you protect yourself? How do you cut through all that noise? It really just boils down to asking yourself one simple, powerful question about any company that's caught up in a hype cycle. Are its revenues growing as fast as the hype? Is the actual business performance keeping up with the stock price? This one question is like your North Star. It forces you to look at the real numbers, not just the exciting story. It's the difference between gambling and investing. And it's exactly what Wall Street was doing with Alphabet and Meta. All right, we have covered a ton of ground. We've talked about the massive spending, the smart way to use debt, the market's weird reactions, and the classic hype cycle. So now for the most important part. How do we take all this knowledge and turn it into a practical, actionable plan for your own investments? How do you make sure you benefit from the AI revolution without becoming its next victim? Here it is, 4 simple rules that will serve you well for your entire investing life. First, focus on the business, not the bet. Put your money in companies that can actually show you how they're making money, companies with clear, growing revenues. Second, diversify. I know it's tempting to go all in on the hot new thing, but it is so risky. Sure, big US tech companies are an important part of a portfolio today, but you need to build a balanced portfolio around them. Third, be consistent. Just stop trying to time the market. The winning strategy is to invest the same amount on a regular schedule month in and month out, no matter what the headlines say. And finally, number 4, be patient. True wealth is not built in a few weeks. It's built over decades by letting the magic of compounding do its work. You know, at the end of the day, your biggest advantage as an investor isn't some secret stock tip or a fancy algorithm. It's understanding these core ideas. It's knowing the difference between good debt and bad debt. It's recognizing the stages of a hype cycle while you're in the middle of one. This knowledge is what protects you from making emotional decisions and costly mistakes that wipe out most investors in the long run. It really all comes down to a choice between 2 paths. The average investor, they chase the hype, they buy at the top because of FOMO, and then they sell at the bottom in a panic. They're on an emotional roller coaster. The smart investor does the exact opposite. They study the fundamentals, they invest consistently over time, and they stick to their strategy, tuning out all the noise. The choice of which path you want to be on, that's completely up to you. But I promise you, the results are worlds apart. Building wealth isn't about being perfect. It's about avoiding the traps that keep most investors stuck. If you can understand how the smartest companies use debt and how hype can distort opportunity, you're already thinking like a real investor. Start consistent, stay disciplined, and let time and diversification work in your favor. If this video helped you see your financial strategy in a new light, like it, subscribe, and share it with someone who wants to invest smarter in 2025. Here at Invest Education Hub, we turn financial complexity into clarity, one smart decision at a time.